The budget is great on intent. Results will come from faultless execution. This is the budget to take India to $5 trillion economy. This budget has accepted the role of entrepreneurs in job creation. It has accepted that working for profit is a legitimate motive. Indian entrepreneurs are similar to Abhimanyu. They are born in Chakravyuh. They fight the Kauravas, that is market and competition. Unfortunately, they also battle Pandavas, that is costly land, labor, capital and complex regulations. Having acknowledged the role of Abhimanyu in this Bharat, we have to support Abhimanyu to break the Chakravyuh and emerge victor like Abhinandan Vardhaman, who came out victorious. The budget has shown path-breaking intent on strategic divestment of public sector enterprises. It has also recommended reduction in government holdings below 51% in non-bank PSUs. Counting holdings of government-controlled entities in the 51% limit is a masterstroke. Now we have to ensure that divestment happens like Hindustan Zinc and Maruti Suzuki. It should certainly not happen like last year's Air India, where no one bidded. Today this PSUs take directly and indirectly between 1 lakh crore to 2 lakh crore from the budget. Tomorrow they can contribute similar amount to the budget if we do strategic divestment correctly. That transformation is key to $5 trillion economy. Opening up of gilt market for FPIs, including sovereign bond issuance, is another path-breaking intent to raise non-tax revenue without crowding out private sector investment or raising domestic interest rates. We have to ensure that we receive long-term and stable FPI flows. This is possible only if India becomes part of emerging market bond index. We should ensure that adequate safeguards are built on the FX borrowing so that we don't end up suffering in a global crisis like 2008, or we don't end up in a situation like the early 90s where we had to pledge gold for borrowing. Deepening of bond market and increasing retail participation in gilt market through interoperability of depositories is a welcome step. We must follow up with implementation of Khan Committee report so that our debt markets are vibrant. Liquid market and availability of hedging tools like interest rate futures and options will lower the risk of investing in gilt, and it will help bring yields lower. Budget has focused on getting higher FDI and FPI flows, recognizing the limitation of domestic savings. Our savings have fallen by more than 8% in last 10 years. Augmenting local savings with global savings is necessary to achieve $5 trillion economy vision. Interactions during annual investor summit will act as a catalyst for more FPI and FDI flows. Simpler KYC norms for FPIs is a welcome step to increase ease of doing investment. We must follow up by inviting domestic investors for annual investor summit. We must simplify KYC for domestic investors so that buying mutual fund becomes as simple as buying a gold ornament. Increasing minimum public holding in listed companies to 35% and FII limit in government companies which are part of equity index to sectoral limit is a step to increase our weight in MSCI emerging market index, and it will create fresh demand from FPIs. The increased supply of about 3,75,000 crore has unnerved the market. Now after creating supply, we must focus on creating demand. We can increase participation by EPFO and PF funds in equity market, or we can give some incentive to mutual funds which will create necessary demand. SEBI should also quickly give the timeline within which this will be accomplished so that market is better prepared to absorb supply. Monetization of surplus lent by government and PSUs for affordable housing is a step in the right direction. We should demonstrate the same by quick execution in few places where real estate demand exceeds supply. We must ensure that we don't end up adding supply in places where demand is already subdued. Setting up of payment platform for government entities for MSME should be extended to all suppliers, as delayed and disputed payment from government is one of the big reasons for slowdown in India Inc. Incentive for electric vehicles as well as affordable housing will boost growth in these sectors which are in need of support. But similar steps should be taken to support demand in auto and real estate market. In our opinion, the future of automobiles is from fossil fuel to hybrid to electric. The tax benefits given to electric vehicle should be extended to hybrid vehicle, and a roadmap in consultation with existing players will be right way to introduce change. government should seriously think about reintroduction of tax benefits on second housing loan, which will help in increasing demand for real estate, and real estate will have multiplier benefit to the economy. Controlling fiscal deficit at 3.3% is remarkable intent. However, in order to achieve the necessary revenue collection, economic growth will have to pick up. It has to pick up substantially from current level. Appropriate liquidity, reduced cost of capital, smoother transmission of credit, along with increased case of doing business will be required to achieve revenue target. With fiscal situation under control, care should be taken to limit off-budget borrowing so that private sector investment is not crowded out. Providing first loss guarantee on securitization of good NBFC is an innovative move. Such benefits should be available to all investors who invest in this securitization and not just to the banks. Government must work with Dr. Jalan committee to ensure that additional resources are available for PSU Bank from RBI reserves. Governance framework of PSU Bank also needs to be strengthened so that we don't end up creating fresh NPAs from this credit expansion. While the objective for increasing import duty on gold is to deter gold consumption, the care should be taken to ensure that gold smuggling does not revive. Growth in Mumbai-Dubai traffic will be a good indicator. The budget has levied tax on super rich to the level last seen in 1992. However, this burden is coming only to the salaried class. We must now break the taboo of taxing rich agriculturists. This budget has pushed for higher tax compliance. TDS on cash withdrawals, faceless assessment, encouragement for digital payment, pre-filled IT returns. These are all steps which will enhance tax compliance. The budget has shown the right intent to make India a $5 trillion economy. The key will be faultless execution.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.